Okay, let's dive right into this ultimate exam-oriented explainer of the Companies Act, Audit and Auditors chapter. Look, I know this specific chapter can put you to sleep faster than a heavy lunch, but today we're going to lock down absolutely every limit, form, and timeline for your upcoming CA exams. If you're looking for conceptual clarity mixed with a high-speed revision that targets exactly how the examiner thinks, you are in the perfect place.
Our agenda today naturally follows the auditor's life cycle. We'll start with number 1, qualifications and prohibitions, then 2, auditor appointment timelines, 3, powers, duties, and fraud, 4, resignations, removals, and penalties, and finally, 5, cost records and audit.
All right, let's kick things off with Section 1, Qualifications and Prohibitions, covering Sections 141 and 144. Think of this very first phase as the gate. An individual CA or a firm has to walk through it to actually be appointed. But students constantly confuse the disqualifications here, especially when we're talking about the auditor's relatives. We know a body corporate is disqualified, right? We know an officer or employee is disqualified. But the examiner's absolute favorite trap to set for you is when your relative holds securities, owes money, or gives guarantees to the company. This right here is a massive 3-star high probability area. You have to remember that step relations are included for almost everyone under the definition of a relative: father, mother, son, brother, sister. But it does not include a stepdaughter. This is a classic RTP and MTP trick question. If the examiner throws a curveball and says, the auditor's stepson holds shares, boom, disqualified. But if it's the stepdaughter holding those exact same shares, you are perfectly eligible.
And that beautifully illustrates our next massive trap. A relative can hold securities up to a face value of 1 lakh rupees. But if they cross that line, you get exactly 60 days to take corrective action, or you're instantly out, disqualified. Now notice I emphasized face value, not market value. In real-world business, if your father buys shares worth 2 lakh rupees in market value, but the face value is just 50,000, you're totally safe. Do not fall for the market value trap in the exam hall.
Another number the examiner absolutely loves asking about is 20. 20 is your absolute hard ceiling for company audits per individual CA partner. But here's the catch. You must exclude one-person companies, small companies, dormant companies, and private companies with a paid-up share capital under 100 crores. So picture a firm with 3 CA partners. They can collectively sign off on 60 standard public companies, plus an unlimited number of smaller dormant ones. To avoid disqualification under Section 144, you need this memory trick. You cannot provide prohibited services directly or indirectly to cash. That's the company, its subsidiary, or its holding company. Why? Because it completely ruins your independence. You literally cannot be the one doing the bookkeeping and then audit your own work. But note carefully, associate companies are not in that cash mnemonic. Sneaky exception, right? Quick recap of this section before we move on. Stepdaughter is safe, market value is a trap, 20 is the limit, and avoid cash.
Let's move smoothly into Section 2, Auditor Appointment Timelines, governed by Section 139 rules.
Welcome to the handshake phase, where you actually get hired. The crucial takeaway here is contrasting these timelines. For a non-government company, it defaults to the board in 30 days, and if they fail, to members in 90 days. But a government company, it passes from the CNAG to the board, and then to members. Look at that specific flow. Non-gov is 30, then 90. Gov is 60, then 30, then 60. So if the Comptroller and Auditor General fails to appoint the first auditor for a brand new government power plant within 60 days, the board has to step up immediately in the next 30 days.
Whatever you do, never mix these tenures up. Subsequent auditors for normal companies get a really comfy 5-year block, holding office from the first AGM till the conclusion of the 6th. But government auditors, they are on a strict year-by-year leash. The CNG must actively appoint them within 180 days from the start of every single financial year. Now let's talk rotation. Think of the 10-50-50 rule. 10 curs for unlisted public, 50 curs for private, and 50 curs for public borrowings. If a company hits any of those limits, your individual auditor has to cool off for 5 years after 1 term, and an audit firm cools off after 2 terms. Oh, and keep in mind, one-person companies, small companies, and dormant companies are completely exempt from this entire rotation headache.
All right, time for Section 3, Powers, Duties, and Fraud, covered by Section 143.
Okay, so you've got the job. Welcome to
the watchdog phase. When you are writing your mandatory reporting points during a theory exam, use the auditor report mnemonic to easily recall them. It is an absolute lifesaver for structuring your answers. For example, A for adverse remarks, U for unpaid dividend, D for director disqualifications. So if you're auditing and you see a director who hasn't filed financial statements for 3 consecutive years, they're disqualified under 164(2), and you absolutely must state that in your report.
Pay close attention because this is a 3-star concept. If you uncover a massive fake invoice scam that goes over the 1 crore rupee threshold, you must strictly follow this 245 15-day escalation ladders straight to the central government using Form ADT-4. If the fraud is less than 1 crore, you just report it to the board within 2 days and they disclose it in their board's report. But the second it hits that 1 crore mark, the central government is getting involved.
Rapid fire revision time. Think about the financial consequences of staying silent on fraud. Let's say you spotted that 1 crore scam, but you decided to look the other way to protect your client. What exactly does the law do to you? Well, for listed companies, it's a massive 5 lakh rupee penalty, and for other companies, it's 1 lakh. You really do not want to take that kind of risk.
Now for Section 4, the messy part: resignations, removals, and penalties under Sections 140 and 147.
This is the exit, and let me tell you, it gets incredibly ugly if you leave improperly. If you resign and just forget to file Form ADT-3 within 30 days, you are paying a penalty entirely out of pocket. We're talking 50,000 rupees, or your remuneration, whichever is lower, plus 500 rupees a day up to 2 lakhs. You have to file this form with the company, the ROC, and if it's a government company, the CNAG as well. Never, ever just walk away without that ADT-3.
And beware the ultimate examiner trap right here. Section 145 for tribunal-ordered removal doesn't just kick you out of that specific company. It bans you from auditing any company in India for 5 whole years. If the National Company Law Tribunal finds you acted fraudulently, whether they did it suo motu or via a central government application, your career is basically put on ice, and you face direct criminal liability.
Finally, we've reached Section 5, Cost Records and Audit under Section 148.
Let's decode this mini-chapter. Students notoriously skip cost audit, but examiners love to exploit it. Do you see the difference in these limits? Just because a company crosses the 35 core overall turnover mark to maintain cost records, that doesn't mean they automatically hit the massive 50 or 100 core turnover triggers for an actual cost audit. The examiner will give you a non-regulated company with an overall turnover of 80 crores. Are they liable for a cost audit? No, they missed the 100 core threshold. But do they have to maintain records? Yes, because they crossed 35.
You need to memorize this exact sequence for your MCQs. The board appoints the cost auditor within 180 days of the financial year start, and then CRA 1 through CRA 4 tracks the whole process. Think of it totally logically. First, you maintain the records, that's CRA 1. Then, you appoint the auditor and let the government know, CRA 2. The auditor does the work and issues the report, CRA 3. Finally, the company files that actual report with the central government, which is CRA 4.
Okay, before we wrap up this revision explainer, let's really test your recall of the most tangled timeline we discussed today. Imagine a newly registered government railway company. The clock is ticking, 60 days have passed, and the CNAG has done absolutely nothing. Who steps in, and exactly how much time do they have? If you said the board of directors within 30 days, you are perfectly on track for an AIR level score. And remember the whole chain. If the board also fails, it immediately goes to the members in an EGM for another 60 days. That's your 60-30-60 rule in action. Review these timelines one more time tonight and really solidify those mnemonics. Take these numbers, the stepdaughter exception, the 10-50-50 rotation limits, the 245-15 fraud escalation ladder, and absolutely crush your exam. But ask yourself this one final thought. If the examiner flips a private company to a public company halfway through a huge case study, will your limits hold up under pressure? Keep revising, stay sharp, and I'll see you in the next revision explainer.